welcome. Good evening. I'm Kavita Thaplayal and you're watching The Money Show, where we simplify money, markets and personal finance to help you make smarter financial decisions. And today on The Money Show, we focus on a subject that is both emotional and financial. Planning for your daughter's education. That's right, it's our Women's Wednesday episode where we are talking about daughter's education financial goal. Because here's the reality. In India, education inflation is running at 10 to 12% annually. That means college costs are doubling roughly every 6 to 7 years. A course that costs almost 20 lakhs today could cost 70 to 80 lakhs in 15 years. So the real question is your investment growing at the same speed as education cost? Let's decode that. When it comes to investing for daughters, many families make two key mistakes. First, they plan mainly for marriage. Second, they underestimate the real cost of higher education. That's right. And in today's world, the strongest financial gift you can give your daughter is quality education and financial independence. Now, if your daughter is 3, 5, or even 10 years old, have you calculated what her college education will actually cost at 18? Is a fixed deposit enough? Is Sukanya Samriddhi Yojana sufficient on its own? Or does long-term equity investing play a critical role? To help us break this down, we are joined by Harshvardhan Roongta, our expert on the show. Hi Harsh, good evening. Welcome to the show. And let's start with basics. I know we've had this conversation umpteen times, but then, education inflation, let's just start with that. Education inflation in India is 10 to 12%. How badly are parents underestimating this while planning?
Hi, Kavita. I'm glad you brought this topic up because this is something which is an obvious topic, but most neglected in the same time. Now, you correctly highlighted that when you look at any daughters in any family, most families would essentially plan for a grand wedding. And in terms of education, the common excuse that is given is that we don't know what the kids' interest would be when they grow up, so we don't know what to plan for. Irrespective of the situation, what I'd suggest is that you create a corpus. Now, that corpus is an estimate that every parent will make at this point in time. Now, you may say that, look, depending on what our financial status is, we would like our children to go to, say, an X kind of a university or Y, whatever. In any case, let's plan to create a corpus of, say, 50 lakhs, 1 crore, or 2 crores, or whatever amount that you think, right? Now, what you could do is initially start with that corpus, thinking that I want to accumulate, say, 1 crore, for example. In case your child lands up doing a course or studies which are not exhausting your entire 1 crore, you can most certainly use that money for something else. However, not having any corpus is going to be huge, huge disaster in future because without sufficient and you will say postgraduate education as well, not just basic graduation, having a career in any field is going to be difficult. Even if you're doing your own business, you need to be very, very well qualified. That's the situation today. So coming to the kind of products that we talk about.
Right.
Now,
So we'll just take it. Right. So we'll just take it one by one. It's very important to understand the crucial aspect and the intent of this particular goal. Now let's just take a practical example, Harsh. If a parent needs 75 to 80 lakhs in, say, 13 to 15 years of higher education, how much should they be investing monthly starting today?
okay, so you'll have to just give me a minute. So
Sure.
you said in about 15 years,
Yeah.
you're expecting a return, you're expecting a corpus of about what? 75 lakhs, right?
Right, 75 to 80 lakhs. And considering inflation, because education inflation is in double digits in India and it's just multiplying every 6 to 7 years. So, what's ultimately the financial goal that you should be keeping in mind?
So see, if I were to just assume that we're looking at a corpus of say 75 lakhs after 15 years, and if you choose a product which is like a mutual fund through SIPs, you will need to park about 15,000 rupees every month. And we assume that this will grow at about 12% per annum. So that is the CAGR that we're assuming. Now, I want to highlight, since we're on this topic and we're since getting into the calculations, now this 15,000 rupees a month is an estimate based on an assumption that your investments will grow at about 12%. Now, most parents I know would say that, look, we want something more safe. We like the Sukanya Samriddhi, we like fixed deposits, we like insurance policies for that matter. Now, if we were to look into that, and if I assume an 8% kind of a return, so here in the first scenario, we calculated 15,000 per month to be a contribution, assuming a 12% return, which an equity SIP is capable of delivering. Now
Right.
we look at 8%. Now your monthly SIP in this case would go up to approximately 22,000 rupees. So not only that you need to start investing early, you need to also have the right product so you can accumulate the correct corpus.
Exactly. Now coming on to the products aspect, Harsh, very important. Sukanya Samriddhi Yojana, a dedicated investment instrument for girl child and her financial well-being. But is it enough by itself, or should it only be treated as a safe portion of the portfolio?
So, Kavita, the answer lies in the question itself. I'll tell you how. We started with saying the inflation for educational expenses is approximately 10 to 12%,
Right.
which means that the fee that is going to be charged in 2026 now will be more by about 10 to 12% per annum in 2020, in 2036, which is 10 years from now. Now, what you choose to do is you say that, look, I want to save for the future. So you're setting aside some amount of money today in a product that is delivering about 7 to 8% kind of return. Sukanya Samriddhi gives you about 8.2% as an interest every year. Now, if your investments are growing at 8% or 8.2% and the expenses are going by about 12%, you're never going to be able to match up with the rising cost of education. What is important is that your money needs to beat inflation, at least that inflation that you're targeting. So if you're saying educational inflation is 12%, it's important that your investments also generate those kind of returns so
Sure.
that you can accumulate wealth in the real sense. Having said this, Sukanya Samriddhi is a brilliant scheme. You cannot you cannot solely rely on that to fund your entire education. You need to have a mix of Sukanya Samriddhi, debt, as well as equity SIPs.
All right. That being said about Sukanya Samriddhi Yojana, let's also analyze the role of equity and equity mutual funds and investing through SIPs and equity mutual funds. You know, what role does it play and in a long-term financial goal, just in case you have set this for yourself or your daughter, is a 60 to 70% allocation reasonable, or one needs to go much higher? I'm sure it depends on the amount of corpus you want to accumulate, but also what should be the investment ratio, say, between equity and a Sukanya Samriddhi Yojana?
So, well, Kavita, one is that you need to look at your time horizon. So, equity via SIP is recommended for a period of at least 8 years and beyond. So,
Sure.
that is the time that we're looking at to ride the volatility of the market. Having said this, Sukanya Samriddhi has a limitation of 1.5 lakhs in a year. So, in case you're investing 3 lakhs in a year, I would suggest that 50% by default will go into Sukanya Samriddhi and 50% should go into equity SIPs. If you're going to invest more than that, most certainly everything over and above 1.5 lakhs will go into equity SIPs. Now, besides the fact that it should go by force, I'm also saying by choice, try and pick a product that has the potential to beat inflation over a longer period of time. You will, I just elaborated with an illustration saying that if you had 15,000 rupees to invest, you'll accumulate 75 lakhs through an SIP. The same 75 lakhs, if you want to accumulate through a fixed deposit kind of a product or something that generates 8%, you need to start investing 22,000 rupees every month. So most certainly you have to make your money work very efficiently for you. You work very hard for the money and money goes and sits in a fixed deposit doesn't make sense. I mean, your
Absolutely.
money has to work harder than you do.
All right. You know, let's also assume that parents have started late, let's say that they started when the child is already 10. How should the strategy change over here? What should be the focus?
So see, if you have 8 years and beyond, after which you need the money, then equity SIPs work the best. So you will have to, get used to that volatility, understand the volatility, also understand the fact that yes, markets behave in a very different manner than what a fixed deposit will behave. In a fixed deposit, you will for sure know that you're going to get 8%, 6%, whatever is the rate of interest. When you're investing into markets through SIPs in mutual funds, there is no guarantee of the kind of returns that you will generate even after 8 years. So you have to understand the product, you have to understand the potential of this product to generate returns, and you have to also understand that this product is not going to perform linearly. If you're saying
Right.
12% every year kind of a return, it's not going to generate 12% every year. It is going to be negative in a couple of years, it's going to be flat in a couple of years, and in a couple of years it's going to go up very sharply, which gives you an average of 12%.
Right.
So make yourself familiar with the product and its nuances. If you understand it, then that's the right way of going about it.
All right, so point taken. In a nutshell, planning for your daughter's future isn't just about saving money, it's about giving her choices. And when it comes to long term goals, time and compounding can do what last minute savings never can. So, that's in a nutshell what you should be taking in consideration when you're planning for your daughter's education goal. But then it's time for a short break on the Money Show, and we will be back with our Women's Wednesday episode. And in fact, we'll focus on women investors' portfolio queries after this break. Welcome back. You're watching The Money Show, and yes, it's a Women's Wednesday episode where we are focusing on women investors' portfolio queries. And before we go ahead, let's just flash our WhatsApp number, because that's the place where you can send across all your financial portfolio details. WhatsApp number and our email ID, where you can again send across your existing investment details, and also give us your financial goals that you want to achieve. And with the help of our experts, we will help you align your investment strategies with your financial goals. Harshvardhan Roongta is our guest on the show today. Harsh, welcome back. Okay, so let's begin the question answer session. And this is a question from Smita. She wants to know about Pocket SIP. Oh, that's very interesting. She wants to know what is it and how can she start investing. So yes, Pocket SIP, Chotu SIP, so many names for it, just because it's a smaller amount SIP that you can. Even a 100 rupee SIP can do magic, Harsh, and especially if you're someone who has not tasted equity yet.
Absolutely. So, Kavita, the AMFI and regulators are very, very clear on this part that, there is a, okay, let me start from the beginning.
Sure.
Whenever there is an SIP that is done, there is a cost that the mutual fund incurs in terms of the transaction. So, if a person does a 100 rupee SIP or a 1000 rupee SIP, there is a cost of getting that money into the fund house, allocating units, etc., against that investment. So invariably, you would see that all fund houses would have a minimum amount of SIP that somebody can do, which is say about 1,000 rupees to start with. Now, when it comes to 1,000 rupees, there was one large segment of people who could not kind of afford 1,000 rupees every month as a minimum investment. So to encourage young investors, to encourage college students, to encourage lower segment of the people to also participate in the mutual fund, industry, there is a concept of pocket SIP and choti SIP which has been introduced. Now, there is definitely a cost incurred by the fund houses to support this kind of an SIP of 100 rupees and 250 rupees. However, that is being done just to encourage young and small investors to get into the fold of mutual funds. Now, what it means is that now the ticket size, the minimum investment size for SIP has been reduced in case of pocket SIP and choti SIPs to even 100 rupees a month, 200 rupees a month, 250, 500 rupees a month. Now, this is purely to encourage people to start participating in mutual funds, and as their income goes up, it is assumed and estimated that their SIP amounts will go up. So that's the industry initiative, and I must congratulate the industry to look into this direction, in spite of the heavy cost that they incur to support such kind of SIPs. So yes, Smita, the concept of pocket and small SIPs, choti SIPs is that you can invest with as little as 100 rupees into a product today, and you can start your investment journey. As and when, of course, your income goes up and you get comfortable with what you're doing, you should increase your investments. Most fund houses are today offering this kind of an option. You can just visit the respective fund house on their website and they will assist you. And one thing for sure is these SIPs will be viable only if you do it online. So all online platforms with the mutual funds will offer you this kind of options. Just explore the fund house websites once, and then you will get to know how to go about doing it.
All right, so that's in a nutshell the advice for you. And yes, definitely you can start your investment if you haven't yet experienced equity or mutual funds. But then, how can she start? What kind of fund she should be? Because do all mutual funds have a 100 rupees SIP going on for all schemes?
Well, I wouldn't say all the 40, 50 fund
Yeah.
houses that are operating
Yeah.
right now would offer these, but the bigger ones, the larger ones, the
Mm-hmm.
popular ones, like SBI, for example, I mean, that's the common name that
Mm-hmm.
why I take SBI as a name purely because the name is, for me, it's a household name and people sitting right, in any corner of India would also know about them. So SBI for sure offers these choti SIPs where they have a balance advantage fund where they're offering to invest into this. Similarly, HDFCs, the ICICIs, Birlas, all these large
Okay.
fund houses will offer these options. And so I think she can just first understand what the concept is, identify the amount, and then she can start with possibly a balance advantage fund of SBI for that matter, if she wishes to start off with her investments.
All right. Can this be done over an app? Because that's the whole trend that we are talking about. A lot of platforms are offering the SIP thing. So how can one go about it? Is that recommended to her? Is that easily available?
So, Kavita, here I would like to say that, any third-party app, okay, is a profit-making organization. You must understand that. And I started with saying that these small SIPs is actually a cost on the entire ecosystem to transact, right? So, eventually over a longer period of time, it will be better that you go with the fund house directly rather than you go through some app, because ultimately the apps, as I said, third-party apps are businesses and they have to make money at one point in time. With a regular SIP of 5,000, 10,000, or whatever amount, they are still not profitable in that context. Now, if you go with 100 rupee where the product by itself is unviable in the commercial terms, it is going to possibly lead to some choco block in future. So my suggestion is when there is an option to go to say SBI mutual fund directly on their website and start investing, why would you then go for a third party app and then probably 2, 3 years down the line, they may suddenly say we're not going to offer this anymore. You'll get stuck at that point in time to make changes at that time. What's the point? When you have directly as an option to go to fund houses.
Absolutely. Okay, so let's move on and let's take Ruxana's question. She says that she's from Delhi, 30 years old, a housewife, and she has retired parents that she has to take care of. And she wants your help to identify the right insurance policy for them. Also, she wants to start a 1000 rupees SIP, and for that, she wants you to recommend a fund. Okay, so first come. Let's talk about the retired parents. I'm not sure whether they are covered as per the employer Mediclaim, but if that is not done, how can she, identify the right policy?
Well, Kavita, now this is a great question with which all of us, or all those listening, should take some lesson out of. Now, if your parents are already retired, which means that they are, of course, senior in age, there could be a possibility they may be having some health ailments, etc. To buy a new health cover at this juncture may become difficult because of pre-existing ailments, because of some pre-hospitalizations that they've already had in the past. There could be a health condition that the insurance companies may not want to offer a cover at this point in time. So many people who are listening, and if you're dependent only on your employer's cover, like we speak to a couple of people, and that time they say that, look, I don't want to bear the cost myself right now because I'm covered by my employer. Now, your employer theoretically will cover you only until you're in employment with them. Now, if you're retired, you're not an employee of that company. Most companies will not extend that cover to retire to employees who have left their organization. And at 60 or beyond, if you're now going to go in for a fresh insurance cover, you're most certainly going to be very, dejected with the kind of response that you're going to get. And that is purely because there could be a health situation or a pre-hospitalization. So my suggestion is that all those listening, we'll come to Ruxana's query later. All those listening, ensure that you buy an independent health cover and all other insurances for yourself, assuming that your employer does not provide it. And plan accordingly, not for today, but at least for an age that you will not be covered. So it could be 60, 65. You may want to think about it at your age of 25, 30 itself. Coming to Ruxana, of course, you need to first and foremost, or rather, the only insurance that you should be focusing on for retired parents would be to have adequate medical cover, which is the Mediclaim that we typically talk about. Now, this is for two reasons. One, of course, you don't want financial strain on yourself in case of any hospitalization. The other point is you need to ensure that you're able to give your parents the best medical treatment, irrespective of the cost it incurs, right? Because you don't want the medical treatment to be compromised just because you cannot afford it. You're not going to be forgiving yourself if something happens because of this reason. So focus on a Mediclaim cover. Uh, all the leading insurance companies will offer senior citizen covers. So you could go to possibly, you can consider and look at HDFC Ergo's policy, Tata AIG, Niva Bupa, ICICI Lombard. These all companies are offering covers for senior citizens as well. Please go and check First, of course, look up the situation, health situation of your parents. Look up the insurance companies, whether they're willing to offer, apply with them, disclose everything honestly, and then make an application. I repeat, disclose everything honestly and fully. Do not hide any medical condition from the insurance company because it's important that you get the claim and not just the policy document in your hand. So ensure you disclose everything honestly. It's better not to get the policy than to not get the claim. So
Risk profile